I have a client who right now has no federal estate tax liability, but January 1st of 2026, by current law, their estate would owe $3 million in taxes if they passed away. Today, I'm going to talk about the upcoming tax law changes. Watch on for an analysis of a client of mine where we are looking at this currently, and definitely watch to the end where I give hopefully a few helpful tips for your situation. Hey everyone, I'm Andrew. I'm a CFA charter holder and CFP professional. I'm also the owner of Lever Wealth Management, which is the financial advisor for people who scare financial advisors. And what I do is I take the learnings from thousands of iterations I've had with ultra high net worth and high net worth clients over the years, and I give them to you so that hopefully you can apply them to your situation. And today I want to talk about these upcoming IRS tax law changes. And I'll preface this by saying I'm not an attorney, I don't play one on TV, and I'm not going to prognosticate tax law changes in the sense that I feel like it's the same as asking someone what the stock market's going to do in 3 months. I have no idea. So right now, a married couple, the husband will get roughly $13 million and the wife will get roughly $13 million that they can exempt from estate taxes. And that's a good thing because the estate tax is 40%. Well, the Tax Cut and Job Act that was passed in 2017, those provisions are only good through the end of 2025. And so one of the things that is going to go away, revert back to pre-Tax Cut and Job Act, is the federal estate exemption. And so it's going to go from 26 million down to about half that, about 13 million total, 6.5 million per person. And this client I have with a net worth of roughly 20 right now has no estate tax issue and actually a little bit of room to run here. Today, no issue, but tomorrow, if they passed away, they'd owe the government $3 million in taxes. 2.8, but you get the idea. And so the question becomes, well, how do you protect against that? And so in estate planning, there are really 4 ways that you can do it. The first thing is you gift assets away today and you get them out of your estate. And that does 2 things. If you're under the exemption, it eliminates the issue of you having an estate tax problem, and it gets the growth of those assets out of your estate too. If I give away $10 million today and that 10 million grows to 30, well, all the growth occurred outside of my estate. So it doesn't matter from that perspective. The problem with that is that's an irrevocable decision. When you give assets away, you can't immediately go, hey, may I have those back, right? It's irrevocable. It's in the name. That's why irrevocable trusts are set up. And if you're younger, the less likely it's a good decision to make an irrevocable decision. So option number 2 is, well, you go, I'll give assets over time. And you can do things like set up family limited partnerships. You can gift assets of LLC interests, and you give those to your family or charities over time. And there's the lifetime exemption, which I just talked about, the 26 million going to 13, but there's also an annual exemption, which is 18,000 per person. And so a husband and a wife can give their kid 18,000 each for 36,000. Well, you can do that for each of your kids, right? It's under the federal annual exclusion. So you can give interests of private businesses or real estate that is owned by an LLC. You can give the interest, and you can even discount those interests for what's called lack of marketability, lack of control. And you can hopefully over time reduce your percentage of ownership and increase their percentage of ownership. The problem with this is you have to live, right? You still have growth of the asset in your estate, and you're hoping that the gifting is a more aggressive decrease in your net worth than the increase from the market value of the asset. And so it just depends on who you're wanting to gift to, how quickly you're doing it, that type of thing. It can work. It takes a really good estate planning attorney and a lot of good modeling to understand if it's going to work in your situation. But it probably mitigates the problem of the lifetime federal estate tax. Option 3, and this is usually more helpful if you have private businesses where some family members are involved and some family members aren't, is you buy permanent life insurance to pay out and pay the estate tax at your death. So I live in Indiana. There are a lot of large farmers here who, if you ask them to sell their land, they'll kill you on the spot. They're not going to do it. Well, the problem is if you're worth $50 million and you only get to exempt $13 million, the IRS is still going to want to check, right? And so life insurance gives liquidity to an illiquid estate, which can be good in that situation. Option number 4 is, well, you simply pay the tax, deal with it. So with this client, because they're younger, it's really going to be mostly number 2 and a little bit of number 3 because of their family dynamics. So that may impact you, and hopefully that gives you a little color commentary. Another few things that you should really be aware of, the tax rates are going to go up, all else equal, and the tax brackets are going to get compressed. And so if you're doing Roth conversions, if you can convert today at a 24% marginal rate, or tomorrow at a 25% or a 28% tax rate, you should do the conversion today. The standard deduction is going to go down, but personal exemptions are coming back. And so depending on your family dynamic, you could be in a slightly worse or a slightly better tax situation. All that being said, I'm assuming that this is going to occur. If there's tax legislation that's passed towards the end of the year, it could change everything, right? However, I think good planning takes that into account and creates optionality, but you can't count on that. And so you need to create an asymmetric return distribution to your favor, regardless of the tax legislation that either does or doesn't happen. But those are a few things to be thinking about, especially with the estate tax changes. My last encouragement to you would be this. If you work with an estate planning attorney, I bet you they are already really, really busy. So if you need to make changes, you probably need to call them sooner rather than later. So hope that's helpful. Until next time, talk to you all soon.